Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Kevin Bannerton, Executive Vice President and Head of Wealth Management at R&T Deposit Solutions, to discuss how everyday Americans can maximize FDIC insurance. Kevin, it's great to have you with us. Welcome to Trade Talks.
Thank you very much.
You got it. We don't typically think about FDIC insurance, but certainly what happened with Silicon Valley Bank brought that to the forefront. How has the market reacted to the ongoing tension created by SVB's collapse?
Well, Jill, I think the reactions fall into three categories and depends on the level of exposure. So first, for those with direct exposure to SVB and Signature Bank, the initial reaction was to pull those deposits. And this was heightened due to the high percentage of uninsured deposits held by institutional clients. And then there are those with indirect exposure, which I'll describe as either deposits with banks that demonstrated similar characteristics, but did not experience a trigger event. And those clients took action to reduce their exposure by either reallocating a portion of those deposits to larger banks or increasing insurance by distributing deposits to other banks. And then the third are those with no exposure. So they certainly feel fortunate not having experienced what others have, but they're likely reassessing their own risk appetite and their approach to managing cash and reevaluating their prior assumptions of risk.
Explain the significance this has on the banking sector. How can that negatively affect small and mid-sized banks?
Well, Jill, the U.S. banking system is unique in that most of the credit provided to small businesses and real estate in America is facilitated by small and mid-sized banks. In fact, the ICBA estimates that over 60% of all small business loans are provided by these banks. And that's because they're closest to their communities and they really understand their clients and what their needs best. So that's why a dislocation in this segment of the industry is so important, because it impacts a majority of small business owners and they're in fact the engine of our economy.
What steps are being taken in the banking sector to alleviate these concerns?
Jill, there have been two main approaches, and the first are the coordinated policy actions taken by the regulators that your audience is probably already aware of, and those have helped to stabilize the situation. The second is what the banks are doing right now at the individual bank level, and there's been a lot of activity there. Banks have been educating their customers, explaining their business models and their current financial condition, and many of those banks are doing quite well. And next, they're addressing client concerns by offering programs that provide higher levels of FDIC insurance. For example, programs like our demand deposit marketplace offers up to $50 million of insurance per tax ID. So the good news is that there are solutions that exist today that many people are just becoming aware of that can help to address the concerns clients may have about leaving uninsured deposits with local banks. And this is important because it really enables customers to continue working with their local bank and not feel compelled to have to move the money to larger banks.
And Kevin, how can customers access up to $50 million in FDIC insurance when the cap is only $250,000?
Sure. So for customers that enroll in the program, we allocate their balances across a network of over 350 participating banks in increments below the $250,000 limit, so that all the balances placed in the program are FDIC insured up to the program limit, which I mentioned earlier is currently $50 million. And Jill, just to put some numbers around that, our programs provide 15 million individual customers, together with over 200 billion in deposit balances, access to expanded FDIC insurance across our network every day. And what we found, especially over the last few weeks, is a lot of Americans are still not aware of these programs. And for businesses or municipalities with higher cash balances held with these small and mid-sized banks, they're looking for ways to continue to work with their local banks while effectively managing their risk.
Why is this beneficial for a bank besides reassuring their customers that their capital is safe?
Well, there are a lot of reasons banks participate in these programs, but right now, the most important reason is the ability to enter what is called a reciprocal deposit. And that's simply when a bank sends and receives the same dollar amount when participating in the network. So for example, if a bank sends 10 million in deposits from a municipality into the network, they get the same amount back from other participants. And this ensures that the full $10 million of deposit is fully insured. But instead of losing those deposits to other banks, the bank receives the same amount of deposits back from the network. And this is incredibly valuable because it's a cost-effective strategy for banks to protect customer balances when compared to other options such as obtaining a surety bond or collateralizing deposits. And it really allows those small and mid-sized banks to level the playing field with some of the large banks by reinforcing the community's confidence that their money is safe with local and regional banks.
And finally, what else should we be watching for going forward?
Well, Jill, despite the recent events, overall, the banking sector is healthy. And that said, there are several risks banks are working through right now, including how best to manage their liquidity risk and perceived counterparty risk. So for liquidity risk, banks are rethinking their assumptions about deposit stability. For example, the ability to move deposits with a click of your phone. It's a newer development and increases liquidity risk, particularly in times of stress. So banks are going to have to reassess their assumptions about depositor behavior as part of their funding strategy. And this means there's going to be more attention paid to the level of insured or uninsured balances that banks hold on their balance sheet. The other is really managing perceived counterparty risk. Consumers and businesses alike will be thinking more about diversification, not having too much concentration in one place, with businesses taking the extra step to look at operational risk. But it's important not to overgeneralize these points because the answers to these questions are best determined at the individual bank level, where bank executives consider the needs of their customers and their own business models. So from what we've seen, most banks are taking proactive steps, working with their clients to find the right balance of solutions and utilizing programs like ours that really can play a part in the process.
All right, Kevin, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.